Hey there, everybody. Welcome back to Number One Leading Ladies. This is you-know-who, Kaylee McMahon, and I have a special guest today, Ann Cohn, and she is visiting us from out of Texas. So I'm going to let her talk about herself a little bit. Go ahead and introduce yourself to our audience. This is a show built by ladies, for ladies. Men can listen too, but we work on building each other up instead of tearing each other down on Number One Leading Ladies. So with that, Ann, please do yourself some justice for me.
Yeah, Kaylee, thank you. It's good to talk to you. My name is Ann Cohn, and I am out of Atlanta. I am a senior vice president with CBRE Capital Markets and the Debt and Structured Finance section, which is a long way of saying I do apartment finance. So anybody buying, selling, constructing apartments, I do financing for. And it's been an interesting time, I think, with COVID. What I specialize in are government-insured loans, and those are, because they're non-recourse and longer-term, low-interest rate, my specialty is more kind of counter-cyclical. So when things are going great and everybody's got money, I do okay. When money tightens up, banks aren't lending, everyone comes to me because the government is always going to insure these loans, and so it's kind of a long process, but. So it's been a really kind of busy time, but this is a different time than I think from the last recession that people are kind of starting and stopping and saying, where are we now? There's no end in sight, and there's no, nobody knows what this looks like because this is the first time we've been through it. So I think making it kind of a really different scenario.
Now, for some of our listeners, we've got like a range of people who are either not doing multifamily or they're just starting or whatnot. When you say government loans or government-backed loans, what does that mean?
Yeah. So HUD, the U.S. Department of Housing and Urban Development, also runs the Federal Housing Authority Commission and the FHA administration. Sorry about that. And so it's like single family homes, which would be FHA insured. And so when you're a first time home buyer, you can go get an FHA loan that says the government has vetted you out. And so if you default on your loan, that they won't come after you. You give back a home and that's it. And that's the exact same thing for the apartments that I do. So CBRE does the underwriting. We make the loan, but it's government insured to say we've looked at it. 20 million different ways. We verify that it's a good project, that you're a good owner, and we will take the risk on it. And so you pay a mortgage insurance premium similar to a single family, the PMI. Ours is a MIP, mortgage insurance premium. And so it insures that. So it's non-recourse. If anything happens and you can't make your apartment, building payment, HUD will not come after you for everything that you own. So that is a huge benefit.
Now, are there exceptions to that rule?
There are, yeah, absolutely. And those are what are called the bad boy carve-outs. And those are fraud and the intent to defraud the government. So regular, anything happens, it's non-recourse. If they prove that you did something fraudulent, then they won't come after you.
Now, what does that mean? Because, I've got some loans that are just bank debt, a bridge. It's not a bridge anymore, but, each of these are different, and they're different considerations of, like, what I think is equivalent to a bad boy carve-out. Like, it's a no-no either way, like, whether you call it bad boy carve-out or whether it's, like, I don't know what to call it, but it's just something that would cause the loan due or things like that. Is that kind of what defrauding the government, is that by becoming like a bad actor, like you said, fraud, like of that company or in your life or all the above? Or how does that work, and how do they take care of that? They just go after that one person, or what if it's a team?
Yeah, so that's a great question.
I've never asked.
No, that's a great question. I'm glad you did, so I could kind of clarify. So if you own an apartment building and you're making your payments, and just as an example, so you kept taking all the money out of your apartments and they really get run down. HUD will come out because they're HUD insured, and they will inspect your apartment. And so every 2 or 3 years. And so they come out, and it is just a slumlord. There are health hazards, mold, everything for your residents. And so they'll come to you and say, Kaylee, you gotta fix these, and you've got to bring this up to standards. And you say, oh yeah, I definitely will. And you do nothing. And you purposely try and kind of circumvent the whole system. HUD will force a sale for you to sell the property because of the residents and all of that. We didn't have it at CBRE, but there was another group that refinanced an apartment project, and it was a big, huge apartment project, and they were going to do rehab on the units, and they were going to spend probably about $25,000 or $30,000 per unit in this building. And so they had an escrow. As soon as they closed, they took the escrow money and left. And so nothing got done, and the repairs weren't made. And so the lender had made the loan, and they had absconded with all of it. So that was in a partnership, and they went after everyone saying, you purposely did this. It wasn't like, COVID hit and people couldn't make their payments. And so you really have to purposefully try and do wrong for them to come after you. But if you and I were in a partnership, it depends on what our LLC looks like and who's the managing member and who has signed the guarantors on it as guarantors. But they will look for recourse in that event.
Okay.
Because it's fraud.
Okay, interesting. Because I was like, I know what happens if someone dies. Usually that's why it's good to have more than one person. There's the other person kind of takes over, or like if one person goes to jail, I didn't know if that counted as that problem or if that's their own thing, and then the other person just kind of takes care of things while that's being handled, or, you never know.
Yeah. No, that's and this is kind of, what I like to think of it is, if you tie a string around this apartment complex, everything that has to do with that apartment complex. So, if you go out and, do something that is not good, I was going to say rob a bank, but I think that'd be a felony. So that would be bad. But, do something. They're not going to look at it and say, here's what you've done. They're looking at how you're operating with this apartment complex. But that's after the loan is made. Before the loan is made, we do full Google searches and background check. And I tell people up front, we do credit criminal background checks. We check the U.S. terrorist list. You can't be delinquent on any federal debt. So it's an in-depth review to make sure that we're dealing with who we think we're dealing with.
Right. Okay, cool. Just wanted to ask those because it was like on the top of my mind. I didn't know how that worked, and I'm sure I'm not the only one. So I guess that was one of my questions after you've introduced yourself. Now there's a couple of questions that we typically ask, and there's so much knowledge in your head though that I think I'm going to ask some other questions if that's okay. I kind of fly by the seat of my pants. So one of them is usually, and this may be applicable too. So I guess when it comes to your profession, and I believe if I'm saying this right, y'all originate debt and also service the debt as well.
That's right.
It sounds like you've been in the business for how many years now?
Over 30. I think I started out my career, and
so you've seen the whole recession and exactly how that works with what y'all offer and how it's changed and whatnot. What in that whole time period would you say has been like the biggest lesson? And I guess that lesson sometimes helps people like me who are newer when we're coming into these issues with COVID, where it's like, well, we're going to assume this is a financial crisis, but it's more like a national disaster, but we'll assume, what could that look like? What's been some big lessons over the years that you've learned?
Yeah, that's a great question. I will say I have learned more in difficulty. I have a dog who's down here I don't know if you can hear.
Oh, me too. There's mine.
It's here. She is wanting me to let her out, so she's whining over here. So bear with me a minute. But so in my whole career, I have learned so much through adversarial times, through bad times, and I think my greatest takeaway is through those adversarial times when you just think, this is horrible, I'm never going to make it out of here, I'm never going to be what I think I'm going to be, I'm never going to do what I think I'm going to do. There is so much opportunity that you just need to take a step back and quiet and really kind of open up and look at it. So that is my biggest kind of takeaway. I just have learned so much during those down times that I just thought, I'm going to be ruined, I'm never going to work again. And that has come the greatest opportunity. So I think if you really kind of think outside the box and think, okay, this is a horrible time. The recession was a horrible time. What are people doing? What are people needing? What, my brother has always said that the greatest thing that you could do probably is to own a liquor store, because you celebrate in great times, and when you're down, you've got to go get something to drink. And so that's a really kind of an open mindset, thinking, wow, okay, yeah, that is kind of interesting. So I think kind of quiet your mind and listen and listen to what I think the stories that are out there, and see what your opportunity is. And what goes hand in hand with that, I think, is understanding what you do best, and really what you do best, what you love doing, and 100% what you hate and can't stand doing. And that is not non-negotiable, because we all have to do something that we don't want to do, but to understand what you're good at and then search for those opportunities.
Yeah. Well, you're exactly right, because, part of all this change has been pivoting, you know what I mean? And some of the things that I try to think about is like being resilient is really tied into thinking about what you do have versus what you don't have. So like for me, it's like, well, there's a lot of stuff up in my head, that I could use either to help other people, or I could use it, for example, to, I'm creating some courses, you know what I mean? There's a lot of stuff up here, and I find when I have a conversation with somebody, I want to just brain dump, and they kind of glaze over after 3 minutes. And okay, well, that's not really helping anyone, so they just need to take it in doses. And so it's more helpful for me to be able to, record it and then have it available at someone's convenience, and then be able to say, okay, well, I have this available, but to be part of our network, it'll be a little fee. So things that benefit me, but also benefit them based on what I already have, instead of trying to go search, for more stuff. So like, what are my skill sets that I really have? I'm really good at raising capital. So, throughout this entire time period, I have volunteered for every freaking trust company in the United States to ask them to speak at their virtual lunches now, to ask them if I can get their information to put it on like promos, work on my online presence, work on what we do have, you know what I mean? So, yeah. I mean, that's ended up kind of being cool, because, I'm never late for anything anymore, really. I mean, like maybe like a minute, but, I'm not rushing. I don't really care at this point in time what I wear. It's like, I think that there's a lot more value to me as a smart woman who wants to lead, and I'm focusing my time, instead of doing my hair, today driving somewhere and back, I'm reading this book right now. It's awesome. It's called Women Don't Ask. I think it's Barbara Babcock.
I just heard about that book.
Yeah.
Yeah.
Well, you're in Crew, right?
Yeah.
Yeah, so I don't know if it's a virtual thing. I'm guessing it is, but there's a talk coming up in June, featuring the book, her, and then somebody else. And that has actually been a big eye-opening thing for me. In like women in multifamily is my thing. Like that is my niche. That's my area. And I'm trying to figure out why there aren't more of us. What do I have to do differently that people aren't willing to do, or it makes them uncomfortable, or whatever. And for me, it's mostly that like I have a lot of I'm not super masculine, but more so than like the average woman, where I don't mind kind of like almost playing that role of being one of the guys and whatever. But you don't need to take away your femininity to be able to get what you want. It's being a better negotiator is actually like where we should focus our strengths on. And so that's what the entire book covers. And so I went running, listening to it, and I'm going to try to get through it. But that's been one thing I've run into as partnerships go, as, doing a deal with a seller, whatever. It's, it's funny because like, not every woman, but a lot of the women that I've come to, and I got really comfortable negotiating in residential real estate, because I'm just like, whatever, we can go back and forth 19 times until everybody's gotten what they want. Cool. I don't care. It doesn't bother me. But a lot of people on that first no, or on that first, like, what am I supposed to do with that? They get super uncomfortable, and they just like, they get mad or ball up, or they disappear, or they forget it, and I'm like, we just talk about it, So I'd like to help more women be better negotiators.
That is a totally different mindset. So I think when you see, there are a lot of women in multifamily, I would say, but the difference is, I think the women in multifamily are in property management and asset management, which is safe. And I'm not saying that as a bad thing. I'm saying it's very safe. You're going to get a salary. You're expected to do this job, and this is what you're doing. When you look at people in production like me in origination, I work on commission. So if I don't hunt it and kill it, I don't eat. And that is the risk. And I think most women really shy away from that. So they don't think, oh yeah, I really want to be on commission and be under the gun. I think people are under the gun anyway, to produce and to do whatever your job is. And so I think commission scares so many women that they don't want to take that chance, and they'd rather be back somewhere and not kind of out on the front of it. And I don't know, that's just my opinion, but I think if you start on commission and a not a solid income early, then you get it, you understand it. And I've always felt like you're going to succeed because you will not let yourself fail. I mean, I haven't known you long, but I can tell you right now, you will do whatever it takes not to fail. And and so that's the difference. And I think very successful women are willing to take risks. And, the worst that could happen is in you in negotiation is that you say, well, let's do this. And somebody say, no, that's not going to work for me. And you go, okay, well, how about this? A no is the worst thing. It's not going to kill you. And it's what I tell my people that I work with. It's like, what's the worst that can happen? It's not going to kill you, so move on.
Yeah, and negotiating is so important as there are more single women-led households as we go, and that's another part of my whole initiative is helping more women be able to have cash flowing real estate so that they can not have to work 5 jobs to support their whole family. Yeah. They can also build long-term wealth, but slowly tinker down over time and be able to spend more time with their families. But as women leaders like that, we now have to negotiate, our salaries. We have to negotiate, say, if we're taking care of aging parents, like their care. We have to negotiate with our kids. We have to negotiate with their school boards. So we're the ones that have to do that. Whereas I'd say before the 70s or so, like the 70s were a total time of change, but before that, it was very much like let the man lead. And then we had a lot of improvements in the 70s and 80s, and then now I'm seeing in the 80s to the 90s, there's actually been a 10% decrease in salaries for women. And I'm listening all today, like that, leads to about a $500,000 gap in a lifetime of one career job, which could have put, say, 5 kids through private school, which could have, done a lot for you, leveraged up your lifestyle and et cetera. Or, you could have used it on rental homes and had a portfolio or whatever. But, having that skill set, I think is really, really important. So I like your lesson that, and you're right. You're so right about, hard times really giving you a good perspective on how to handle the good times. So a lot of what you're picking up on, my ability to kind of like bite in and like, I'm not letting go, it comes from my grit, from a lot of crap I've gone through my entire life, and we're still handling it now as an adult. But that is one positive thing I think that has come out of all the adversity that I've had to deal with. So it's not bad. Now, it mentally, I think, gets you to be able to handle it better because, you're going, okay, I've done this before, or I just have to think from a different perspective and take, the weaknesses and use them or not work on them, things like that. But as far as like the financial industry goes, what has been, so say you're in 08 and everything really changed, lending kind of stopped, for a while there. And so I'm sure there was a lot of pivoting that had to happen. what was that like, and what was I guess a lesson, because I don't know anything about it as far as like now they're still lending, so when I'm underwriting deals I can still do stuff. I just have to go, okay, we need more reserves, so that means what I'll do is I'll take down my renovations. I won't do them for 6 months, and we'll just let that stay in an account and then get our occupancy up. And then once we get past that, then all of the money is able to be used for everything, and then we'll start renovating just later. So our business plan will be longer, or, you know, you just pivot a little bit. But when the banks are controlling the lending part of it and they're going, no, like what could people do at that time?
You know, I got to tell you, it was so difficult because everyone stopped lending, and it was very vicious, because I think the banks were not only no longer lending, but if you had any issues, they were going after you in foreclosure and taking everything that you've worked hard for. And there was no, softness. Oh, we understand what you're trying to do. We'll hang in there with you. It's like, no, we want that property, and, we're going to sell it for pennies on the dollar. And so it was a really difficult time. And so many people just lost so much. So I think the lesson out of that is make sure that you are not over leveraged. And just like you said, be ready to pivot, because it's not going to, real estate does not go like this. It's up and down and up and down. And I swear, it's every 10 years. And so when you look at it and you think, oh my gosh, this is fantastic, start putting money away, because it's going to hit, and don't put all your eggs in one basket. I mean, be spread out and be smart about it. But yeah, living through that, it was so devastating. I mean, for the entire commercial real estate industry. And this time is different.
Yeah.
It's not it's a whole different feel. But kind of think ahead and think about worst case scenario and plan on it.
Now, the people that you saw, so for example, in multifamily that survived through that time period, what are some of the things that you saw them either doing or being proactive on, or like what did they do to be able to write it out, or was it restructuring, or, because I've been told by some, like, I really like to bond with people that have been doing this for a long time. Like, oh, you have 30,000 units? Let's be best friends, because I want to hear like what you did so I can protect my team, my investors, all that stuff. I don't need to learn that lesson. You know what I mean? So was there anything you saw people doing in that time period of the last recession that you think really helped, or that you saw working for them?
Yeah, so I would say not being over leveraged. There were loans that were 90% loan to value, and the value was inflated. So when it hit, they couldn't pay it off because, the value was devalued. And so I would say make sure you have a lot of skin in the game. That's hard, especially when you're starting out, because you need some serious leverage. That's why I think you would do well to bring in partners who say, we'll give you this amount, and that you put a cap on it and say, we'll acquire this, and we're willing to put 25% down. We're not going to, we're not going to run a scenario that says we're going to acquire this and then jack the rents up, $100 a month. You might be able to do it. It's not going to be sustainable. So, be thoughtful on what you're doing, and kind of with a forward look is what happens if this goes south. And the other thing that I will tell you is so critical are relationships, and that is financial relationships. I can't stress it enough, because I saw so many of my clients that didn't have banking relationships. They'd go to this bank for this one thing, go to this bank for this one thing, and they didn't have a deep-rooted relationship with a bank. And all those banks would say, we barely know you. We're only taking, chances on the guy who we've been working with for, 10, 20 years. So I think relationships, invest in your relationships. So even if you're not getting the cheapest and the best rate, that will pay off. And that, I got to tell you, that is a hard lesson for me to learn, because I am very thrifty, and my cheapness drives me crazy. And I have to stop sometimes and say, wait a minute, this is relationship building, and it's got to go both ways. I can't always get the best rate, and it can't be all about me. And that's hard. That's a hard lesson to learn.
Right. You're right. What would you consider to be over leveraged? Because I've heard different scenarios there too. Like there's a beginning over leverage, and then there's like way over leverage, 90, 100%. Yeah, it's nuts.
Yeah. I would say we're looking at a regular leverage of about 70, 75%. Anything over that, I think you really need to look at that asset. And I mean, at that point, people were putting mezz debt in for a higher interest rate and the different tranches that were going in there. And, as long as everything was good, they could make the payments but as soon as there is any blip on the radar, it just fell apart. So I would say stay around 70, 75% loan to value.
Because I was looking at the new adjustments with Freddie Mac and Fannie Mae for their reserve requirements, because I was like, man, I got to raise so much more money. And then the investors, when they look at an offering, they're going to be like, why do you need so much money? That's why. So I was like, well, maybe this is a good thing. Maybe now we've gotten to the point where I think I've seen the last couple of weeks up to 65% without the extra reserves. I think higher than that, which it started at like 50, then 55, then 60. And I've been tracking with it every week since COVID's been an issue. But now it's 65. And I'm like, well, maybe that's a good thing. Maybe that's a good thing to where they're forcing us to essentially be more conservative. Because I've got a friend that normally what he does, but again, I don't have the wealth that he has from Colombia, Chile, Argentina, these family offices that are funding all of his stuff. Or what he does is he goes in at 55% leverage. And so that lessens the returns, but then they give him, I think it's on Fannie. Yeah, they give him a 10-year term and 10-year IO. So it's only interest for 10 years. And then also I think they would do a supplementary if they needed it. But it's already included in there anyway. But so I was like, man, do I have to go down to like 55? Holy crap, that's going to kill our returns completely. But I'm starting to see it kind of come up, and I think 65 might be a good thing, just in case.
Well, and I think to your point, exactly. I mean, you're looking at that, and it's making you put reserves in to make sure. But again, if you don't have the relationship with your lender and Freddie Mac, they're not giving you 10 years of IO. They're giving you maybe 3, maybe 2. So that's kind of the whole juggling of it.
Yeah, yeah.
The reserves are key, and I think as it tightens up, I think Freddie Mac's got, a 12-month debt service reserve?
I'm going to get it wrong because I'm like, is it 6 or 9 or 12, and which one's which? I don't remember. It's on a sheet somewhere.
I think it's 12 months. I know that HUD has a 9-month debt service reserve, and so if you hit the 118 cover for 6 months, they'll release it, which 6 months is not bad.
Right.
Not bad at all. So, and it's in your project. It's there as a safety net. So, yeah.
I've never done HUD financing. So I'm going to ask you to talk about that term earlier. I have it written down, so I'll come back to it. But for HUD financing, we talked about what that stands for. I just have done what my mentors have done. So as far as pivoting and being creative, obviously you have to learn more to understand what you're doing and long-term effects and all that. A government-backed loan is great, like you said, because of the longevity of it. It's backed by the government, and for now they're not going anywhere. But what was I going to say was that whenever you're doing a HUD loan, how is it different? Like, I know what a CMBS loan is, and maybe I'll ask about that in a second. It's a commercial mortgage-backed security loan where it's like a pooling of money and et cetera. But a HUD loan, is it just that it takes so long normally to like originate a loan like that usually it's not helpful in a multifamily transaction where it's a hot market and they're like, I want you to close as fast as possible? Is that what's holding people back? Because it sounds like a good program.
It is. It's a great program, but you're exactly right. Because it's government insured, there's a lot of bureaucratic red tape with it. It doesn't work well in acquisitions. It just, it takes 6 months to get through, and you can't negotiate a 6-month, purchase and sale agreement. Where we see it is if someone has already bought with like a bridge loan, or they want to refinance. If someone wants to do a long-term hold, so if you're buying something and you're going to hold it 3 to 5 years and then sell it, I would say you're probably better off with Freddie and Fannie. HUD will do a 35-year term, non-recourse, and today's rate was $250. $250 non-recourse for 35 years.
Plus some, or like what?
What?
Like plus points, or plus like what?
That was the interest rate plus the mortgage insurance premium, which is anywhere from about 25 to 60 basis points in addition. So you'd be at a 310 rate for 35 years. So when you look at it, when you compare it, if you're getting IO and you're working on the appreciation from Freddie or Fannie, that may be better, unless you're planning on owning this for 7 to 10 years, then you're going to see at the end that you've been paying down your principal, and that you've got enough paid down, and the rates are incredible.
Does HUD have, like what we know in single family is prepayment penalty, like a yield maintenance, defeasance, step down? Like, does it have that?
It does. So typically what we quote on the lowest rate is a 10 to 1, 10, 9, 8, 7, 6, 5, 4, 3, 2, 1 in the first 10 years. And it steps down every year for prepayment penalty. So by year 10, you have no prepay, no yield maintenance, no defeasance.
That's a long time.
It's a long time, but the loans are assumable. So, put a $250 loan on it now, you should have no problem selling it as an assumable loan.
Got it.
And in a couple of years, everybody's going to be like $250. Who knows where rates are going to be?
Correct. Yeah, we got a real low rate. Same kind of idea on that one. Now, you mentioned a term, so I'm actually writing a blog right now called multifamily terms. And so I tried to ask everybody, what terms do we always use that you're like, what the heck does that mean? So basis points was one of them. And correct me if I'm wrong, is it 1/100th of a point? Like, is that right? Or 1/100th of of one?
Yeah. It's like pennies to a dollar. It's 100 pennies to a dollar. In a 1 point interest rate, there are 100 basis points.
So like I use that term when we're talking about exit cap rate. When we're saying, okay, we're going to increase by 100 basis points, or we're going to increase by, so yeah, okay. Because everyone's like, what does that mean?
Okay, good. Now I've got the dog that's barking.
No problem. Hey, we're at home, and this is not unreal life. It's real life. One thing that you mentioned earlier that I think I know what it means, but it's always good to ask again. Mezz, or mezzanine debt. What does that mean? Yeah.
So if you're getting a bank loan that goes up to 75% loan to value, you're going to have to come out of pocket 25%. Somebody may offer you a mezz loan, and that is to bridge some of the 25%. So you might get like a 10 to 15% mezz piece. So say your interest on the first 75 loan to value is at a rate of 3%. The next mezz piece, because it's riskier, it's not, it's subordinate to your first mortgage, so they're going to get paid second if you default.
Okay, I was going to ask.
So because of that risk, you're going to pay a higher interest rate, and it could be in level tranches. So they could say, we'll give you 75 to 85% for a 5% rate. We'll give you 80% or 85% to 90% for a 10% interest rate. It's definitely more risky because that's the lower amount of skin in the game that you have. And that was what was going on a lot. There was a lot of mezz bridge funds and crazy funding to get up to 100%. And so again, it was kind of over leveraged.
Right. Okay. Now I think I understand. Now, One thing I want to talk about this being creative, because a thing that we don't want to deal with is when we're going for a Fannie Mae or Freddie Mac agency loan, is having a second lien on that property, because that's a no-no. You have to have permission from the lender. They don't like that. And that's been a lot of topics that's been brought up recently because of the Paycheck Protection Plan, the SBA loans, all this stuff. We're like, is it technically a lien on the property, et cetera? But one thing that I've been able to do, I just kind of want to put this out there, that is pretty cool, is sometimes you have a seller that has so much equity in the property that they can sell or carry, and not sell or carry like the whole deal, but you'll have a note. And what I do is I put them in there as a preferred equity partner. So basically they're a passive or limited partner, but they get paid first, and they get paid a certain percent that we agree upon, and they don't actually have a lien on the property, but they get paid the same amount, if not more, to be able to offer that to us. So and they like that sometimes because, well, they may not have to manage anymore or deal with any of the stuff that happens on a C-class property, which is what we buy. They still get returns. So that's something that, I've come up with in the past that I thought was creative, and you have to be creative, when you're pivoting.
Absolutely. And that's a great aspect, especially with some people who have owned an asset and they're tired, they just want out. But it's hard to, comes with a whole set of different kind of difficulties. If they've owned and managed it and you're coming in, you've got to manage their expectations on it. But I see a lot of kind of soft seconds on the seller debt. Yeah.
Trying to be creative, because, and even when it comes to, like, my girlfriend was in a deal where the lockdown happened while they were under contract, or not under contract, in due diligence, and everyone's like, what do we do? So they got creative, and they did this really cool thing where they basically put a master lease on the place, where they said, okay, well, we're going to put some equity into this so that we've got skin in the game. We're not going anywhere. We need a few extra extensions because we're not sure when this is going to end, when we can actually go in and finish what we're doing. But so they're able to give the seller some money, and they're able to kind of pause for a minute and then finish up kind of once it's opened back up, or once people were comfortable letting them in or whatever. So, being creative right now is so key.
Absolutely. And I think you always have to kind of keep in mind what you want to get out of something and what the other person needs to get out, and how to get in that agreement, that middle area.
Exactly. Now, when it comes to lending, in a space where you're going from, because this is something I know nothing about, but I've been asked about it a million times, and I really feel guilty that I'm so focused on my sandbox, and I'm learning new things every week. I mean, so I'm just going to stay in this area and be where I have to learn only a little bit at a time, and not just a constant fire hose. Is new construction. So when it comes to new construction, my experience has been with like a single family house. Back in the day, I used to help someone purchase lots. He would get a development loan. Then the remaining, he would basically use people with IRAs money to finish the project and sell it for a certain amount and then pay everybody out. But right now, I don't know what that looks like as far as getting an acquisition and development loan, or if you're just doing development. And then do Fannie and Freddie do that, or do they only do properties where there's pre-existing cash flow? How the heck does that work right now?
Yeah, so Fannie and Freddie, I won't do construction loans. I think you've got to get a bank loan and then do a Fannie or Freddie takeout. I do a lot of construction loans because HUD will do construction lending at very good terms. They won't do any development loans. I haven't heard of anybody kind of getting those in a while. So again, you've got to have, be able to secure your site, keep it under control for a while, have your architect doing the designs and doing your market study. So it is very, very expensive up front. And a lot of risk during construction. And while the rewards are great, the risk is great.
Yeah, and so I've kind of also shied away from it because in my head, I've seen it in my neighborhood. I live in an area that's changing quickly, and there's these large homes that you have to for sure have a jumbo loan or some kind of large loan on whatever they're doing. And I've seen one or two, let's just say one, that it just sat forever because there was an issue. And I don't know if the issue was with the bank or if there was like a lien on the property because it's not, whatever it was. but it just sat and sat and sat, and so it rotted. Like, there were parts of the house that it kept raining forever, and I think that people were living in it and all kinds of stuff. So they ended up like
the holding costs.
Yeah, now they bulldozed it. Like, there's nothing there. Yeah. I was like, what? Like, that's the last thing that I want to do, is because, for example, when the lending environment changes, do they get to make adjustments to the draws that you get? Do they get to make adjustments to, like, the rate you were at? Does that change while you're in the middle of having sticks in the ground, And if so, yeah, it's not cash flowing. What else could you do? In our properties, we just stop construction and we have people living there, and it's still cash flowing. It's okay. But that's why I've shied away.
Yeah, so you're protected. Yeah, you're definitely protected because you've got a cash flow property. The holding cost will eat you alive. So, somebody was paying it, whether it ended up going back to the bank or, and all of that was a huge loss.
Yeah. So I had someone reach out to me yesterday about building a new apartment complex, and I'm like, wow, like, you already have the land. Like, let's pull that back a minute. I don't think where you bought the lot, and I'm not going to say anything about it, but do you have, like, a market study? Do you know, like, what kind of area is it in? And he was telling me that most of it is a lower class. I'm like, that's not where you want to build that in, because you want to build, like, a B class and an A class area so you can justify your rents. You can have rent bumps, if not now, eventually. People that eventually have to move from those places because they're too expensive or whatever, they'll go to you, et cetera. So I'm just kind of like, nope. Like, I'll stick with my my rehabs or whatever. God. Okay, so one last question. That's been some awesome knowledge, because that's, I think, a lot of fear that people have right now. And so I don't think I'm unjustified being a little bit skittish about doing a bridge right now or whatever. So, Fannie Freddie, good. Unless we have Daddy Warbucks come in. We're working on that, right now in Dubai. There's a girlfriend and a guy friend of mine who are starting a fund. And I'm like, if y'all can put together this much money, we could do cash offers. We could even do developments, and then there won't be a problem with being able to continue doing things if things change. That would be different, but we're not there yet. So those were really good lessons that you shared. What has been, probably over your entire lending career, your biggest win?
Oh, wow. I've really been fortunate. So I've had different wins. So, I crossed the threshold last year of hitting $1 billion in financing. And so that was a big win for me over my career. And when I started out, I was doing development, and really small development. And so I did that for 20 years. And now $1 billion is really not as much as it used to be, because you're doing $20 million loans, but that was a huge threshold. A win for me has been, I do some affordable housing, and doing affordable housing and seeing the impact that has on families and people with disabilities. That has been an incredible win. We talked about Crew, and I am a member of Crew Atlanta. And last year I had the honor of being president, president-elect president and past president. And the exposure and the knowledge that brings has been an incredible win. And then I gotta say, I love being on the lending side, because I love going into different areas, meeting new people, hearing about what's going on in their areas, assisting them with either acquisition, refinance, kind of maximizing their exposure and kind of setting them up to be able to do exactly like you're doing. Go in and buy something, bring it up, get the bumps, put it to bed, make that cash, and then go on to the next deal. And so I've had wins in so many clients in that way that it's really tough, because I have been very, very lucky throughout my career, just having access and learning new things.
Yeah. So, well, I think if you're a lifetime learner, I think that will always help.
Yeah. Yeah. And, and it goes back. I've been really fortunate to work with a lot of amazing people. And in a weird way, I've been fortunate to work with people who I could not stand and did not respect and didn't trust. And that has taught me to listen to your judgment and listen to that inner voice more than anything, because sure enough, when you don't, that will get you. And I think as women, we just know. I don't know how, but Malcolm Gladwell has a book, Blink, and it is so good. And it's how to trust your inner voice, because your inner voice is true.
Absolutely. That is 100%. I've heard